Hello and welcome back to another small video. We are still talking about imports from third countries, and where are we now? We have spoken about importation VAT at the border by the customs authorities that is levied, and the treatment of the seller of goods. We have now begun to talk about specific or special regimes for special situations. And this time we are going to speak about the electronic interface scheme, which can be found in paragraph 3, subsection 3a, and paragraph 4, number 4c of the German Tax Act. Well, what is it all about? Very often you have a seller from a third country like China, Australia, America, who now in these times is successfully able to sell something to a private consumer within the European Union. That is usually possible by making use of an electronic interface, as it's called, so an electronic portal or an electronic marketplace. So things like eBay, Amazon, or however you call them, you know some examples from real life, I'm sure. And now, in such cases, the electronic interface, the electronic marketplace or so is very often even involved in collecting the money. They know the prices which are paid and everything else. And the seller from the third country is very often completely unfamiliar with the VAT rules and is what also has a significant importance, completely out of the reach of the fiscal authorities of EU countries. So very often that led to the consequence that you have a taxable transaction made by a seller in a third country, that you have somebody, an electronic marketplace, who is under civil law only active as a kind of agent, making the contract between the two parties possible, but not being involved in the contract itself. So that third country seller is in principle liable to value-added tax but doesn't pay. For this reason, one thought about a special regime. The idea was, if that electronic marketplace, which we can get a hold of, if that's here, then the situation gets far more simple. Because we could then say, well, let's regard the electronic interface owner as the seller of the good for VAT purposes. So that this person is not seen as an agent, but is reclassified or requalified as this marketplace is the seller for VAT purposes. And in turn, for reasons of logic, you have to assume then that the actual seller from the third country did not sell to the private consumer, but to the marketplace. So in reality, in civil law, there is only one contract, third country seller to the private person in the EU. And the marketplace is only an agent, a broker, something like that. Now, in the world of the value-added tax system, that unique and single contract is broken up into two similar contracts. First, one contract from the seller to the marketplace, second, a contract from the marketplace to the final consumer. What is the consequence of this? Well, if we imagine that an electronic interface enables a third country seller to sell a good for 100 euro to an EU customer, and then has a right for its agency services to claim a 10% commission for that transaction. The world of VAT doesn't see a service of the agent, the marketplace, to the third country seller, but sees the things completely different. For value-added tax, now we say the electronic interface sells to the private consumer for 100, and in advance, before that, at least a logical second before that happens, the third country seller sells to the electronic marketplace for, well, the 100 minus the commission, which the marketplace can keep for itself, so for 90. There is no service in that world rendered by the marketplace to the third country seller. It's reclassified into buying and reselling. That is the main thing which you need to know here. Now the trick is the marketplace can far more easily be taxed by the fiscal administration in the EU. And now when the third country seller doesn't pay, that doesn't play a role anymore, because as you know, in value-added tax, everything which counts is only the last and final contract. All the other contracts are only taxed for reasons of safety. You want to be sure, or you can usually not be sure if you are an entrepreneur, if your customer buys as a private customer or as a business customer, and so you must be on the safe side and charge him or her VAT. And yeah, so, but you know that chain of entrepreneurs must be neutral, so all the VAT in the chain would be refunded. And in that case, if the third country seller doesn't pay and doesn't register, then the electronic marketplace would not get no refund. Well, everything's fine. And so the fiscal authorities would not lose anything. Only that the last contract is taxed regularly. That is everything which counts, and that is ensured by that rule here. So if contract number one is not correctly dealt with under VAT, that makes no damage anymore. We even will see what consequence will be drawn from that. Well, this solution is simply applied in two situations by the law. First, the electronic interface supports the sale of a good by a third country seller. But the good is at that time already within the EU. That means then simply that you... So let me just start the sentence again because there was a small interruption. We have a situation where a good is already in the EU, owned by a person in China, Australia, South Africa, US, wherever they are. That's a typical situation, for example, with, let's say, Amazon. You have a warehouse of them, not a tax-free one. You have a warehouse of them, and just a simple warehouse, where your good is already stored. Now, when it begins to be sold, the place of delivery is, as you know, where the movement of that goods toward the customer begins. And, well, that is now in Europe, for example, in Germany. So you have a taxable delivery by that third country seller, or you would have it. That would make that person taxable inside the EU. And then you would have the problem that third country seller is out of the reach of the fiscal administration. They probably don't care about their tax liability. They don't know how to register. And the marketplace owner, well, that is within your reach, but you don't have a legal possibility to make them responsible. And so that is what 33A does. They change the situation from civil law to that specific value-added tax solution. The marketplace owner is now regarded as selling you that good. So we have delivery of a good from the marketplace holder to you. Place is where the delivery to you begins, 33A. So this is inside the European Union. And so that's taxable, not exempted. You have a person who is within the reach of the fiscal administrations. And that applies if you sell to private customers. and what a private customer is, because only there you have really material risk of that the tax becomes definitive and is not collected. What a private person is in that context is defined in 3a, paragraph 5 there. The second alternative situation where the same approach is chosen is if an electronic marketplace supports the distance sale of a good which is sent from the third country, so from China, for example, to Germany, when that good is imported then, but has a value of less than 150 euro. That's a bit strange. However, it can be simply explained. If a good has a value of less than 150 euro, then there will be no customs duties levied on it, usually. So that means only the importation VAT would make a problem. And now this is a situation where you can get rid of the problems faced with the importation VAT. If then somebody does not properly register also, then the idea is, okay, if now the electronic marketplace is regarded as selling you that stuff, they pay the VAT, and the foreign deliverer from China, US, or Australia does no longer need to pay VAT inside the country under the 3/8 rule. Well, because then that would be regarded as tax-free. So these two situations are relevant. If you have now a delivery which is higher than 150 euro, then you can't simplify life like this probably, because then you will regularly have to levy importation VAT and customs duties from the seller, and so it's limited to 150 euro because that has an importance for customs duties. Well, yeah. This rule that the electronic interface owner is regarded as the person who makes the sale to the final consumer or customer must be laid down somewhere in the Tax Act, because it does not correspond to civil law. So it's a fiction, so you need to regulate that in your Tax Act. And in Germany, that can be found in paragraph 3, subsection 3a, or subparagraph 3a, USDG. Furthermore, in that case, you have one transport and you have two sales, so it must be said where the transport has to be attributed to. And as it is deemed that the marketplace is the person who sends you the good, the movement of the good or the transport of the good is attributed to the sale which is made by the owner of the electronic interface. That's regulated in 3.6b USDG. What does that mean? Well, in cases where the good is already in the inland when the sales contract is made, the place of the delivery from the marketplace holder to the final customer is then where the warehouse is, under 3.6 sentence 1. You know that rule. The place of delivery is there where the transport of the good towards the customer begins. The previous delivery, the fictitious one from the third country seller to the marketplace holder, is then determined under 3.7. Ownership changes without a movement of the good, because the good has already been 4 months in the warehouse, never changed ownership, never moved, and when then this fictitious transaction happens, the good is in the warehouse, still stays in the warehouse, and is only moved when the next transaction begins. So that is 3.7. Also, the place will be in the warehouse. However, when we have the second situation, that the good is a distance sale from the third country seller to the EU, and the transport of the good to the final customer is then attributed to the marketplace holder, that means, consequently taken, that the transport from, let's say, China to Munich will be seen as a transport which was made by the marketplace owner. So the marketplace owner would be regarded as the person who imports the good, is taxable in the inland industry aid, USDG. And then the first sale from the third country seller to the marketplace holder would begin logically before that transaction. So it would happen at a time when the good is still outside the EU in the third country. So then that would not even be taxable. Also, that would make life more simple. In the EU directive, you have the corresponding rules mandatory for all member states. So what corresponds to our 3.3a is Article 14a of the VAT directive. The rule is compulsory for all member states. The rule about the movement of the good, that this is always attributed to the owner of the electronic interface, finds its parallel in 36b of the EU directive, so you can be sure that these rules apply throughout the EU in the same way. Now, as the tax payment for the last transaction in the chain, the fictitious sale from the electronic interface owner, so from Amazon, eBay, or what else, to the private customer is secured, and as the VAT from the sale of the third country guy to the marketplace holder would only be temporary. It would be taken and refunded because the marketplace guy sells on tax, liable to tax. So you would have complete input tax refund claims. As this VAT has no material importance then, you can make life even easier. Because you can now say with a good conscience that the fictitious sale between the third country entrepreneur and the holder of the electronic interface, if it is taxable at all, is tax-free then. There will be no money lost, and you get rid of bureaucracy which has no importance, brings no money, and which would be difficult to enforce. So in that case, that's also a great simplification. That tax exemption is in our German legislation contained in paragraph 4, number 4c. You see from that letter added that it has been not a part of the original version of the Tax Act in the 1980s, but was inserted later. The underlying rule in the EU directive that says the member states then make that first transaction tax-free is Article 136a. This rule is also compulsory, so the solution will be also the same in every member state. Well, this was just some information on how shopping via an electronic interface works if somebody from a third country is involved in the affair, and that is the explanation why we talk about this in connection with the treatment of import transactions. Well, also this shall be enough for one small video, and I hope you enjoyed it. If not, I hope that you enjoyed that it is over now. Try to press a like button or something else. Recommend the channel to others and make sure that you come back when the next video comes. Thank you for watching and goodbye.